Hey everybody, welcome to Making Multifamily Money. So today I'm actually very excited to bring on a good friend, Wakefield Lee. How are you doing?
Really good. How are you doing, Steven? Glad to be on here with you.
Yeah, no, I'm glad we could finally connect. I kind of saw you're pretty active on the SAR Facebook group and, just been trying to want to network with people better. I've been terrible at that, to be honest, but glad we can finally meet. So to kind of start, can you kind of share about yourself and your real estate investing journey?
Yeah, sure. So a little bit about me. I'm in the Los Angeles area, Southern California. From here, I grew up around the area, a little bit outside the suburbs. My real estate journey actually started when I graduated from undergrad. Went to USC and I studied business. I was deciding between a career in finance, finance accounting, corporate finance, and consulting. And I ended up going to the consulting job, which was in real estate. So I got to consult with various different institutional companies, doing valuations, working on strategy, and really getting a good idea of what big real estate portfolios look like. And I've been in commercial real estate for about 12 years since then.
Wow. Okay. Yeah, I kind of want to dive deeper because I feel like your journey is the complete opposite of mine. Being honest, I started off as a pharmacist, still work as a pharmacist, and I've just been accumulating, uh, real estate over the past like 5, 6 years as an investor side, where I just kind of invest myself. But I kind of want to kind of deep dive into yours. Like, what got you into, I guess, what got you interested in your major that you decided to pursue, or the job that you decided to pursue?
Yeah, well, a couple of segments. So, how did I get interested into my major? So that's a little bit into high school, I guess. And I won't talk too much about that, but I was deciding between going into actually the sciences, so computer science, becoming a programmer, versus going into business. And so I took this computer science class in when I was in high school, and it was at the college level. It was fun, it was great, but really, really hard. And I thought, okay, this is a challenge. I'm learning a lot, but is this the kind of career I see myself in the long term? And I thought, uh I like the work, it's challenging, but I wanted to have a little bit more, I guess, people interaction, and the idea of business was interesting to me because I can do some analytical type stuff and also talk to people and work with groups, and I just like the idea of business. It just seemed broader to me, so that's how I got into studying business. And for USC or business majors, finance is pretty popular. I would say pretty popular careers coming out of a business degree are finance, accounting, consulting, operations, marketing. And for me, I thought finance would be good. I pretty comfortable with numbers. And then I also, at the time, I didn't know this, but numbers are incredibly important, as you probably know, in real estate. Every deal depends on the numbers, and a number that's off here or there can be either very good or very bad. So that's what I realized was pretty important, and it was an interesting field for me. And then as far as getting into real estate, so my parents have a little bit of background in some real estate and investing. They owned a condo, house, couple smaller properties in the local area, very high priced. And then eventually they got into apartment building out of state. I wasn't involved in that at all. That didn't really impact my career, I think. But really, it was more like I did this internship actually in Sony in corporate finance. Thought it was a cool job. Oh, this is fun. And it was really boring, actually. It was just here's some transactions, here's a debit, here's a credit. If you or your people know something about accounting, and it's just recording numbers. And then my job was to basically figure out why did these numbers get recorded and what the mistakes were. And it just it wasn't interesting to me. But it was a very cool company, and I just realized, okay, well, maybe I want something that's a little bit more broad, a little bit more high level, and I get to see the bigger picture of the business and what's going on. So that's how I got into consulting. And the pitch was, okay, you get to work with all these different companies that are very high level and very experienced people. So me, 20 something year old, working with people who are 30, 40 years old and been in the business for 10, 20 years, and I would get to actually learn a lot from them. But I would be able to provide value to them in certain specific ways so that they can do their business. So that's how I got into that first career in real estate.
Wow. Okay. Yeah. Thanks for that overview. Something I kind of want to dive in a little deeper is it's interesting you mentioned that your parents were heavily involved in real estate. Like, I guess growing up, like how much exposure did you get to that? And did you actually learn anything from them, or was it just kind of more, you're just kind of there? Like, can you kind of describe that?
Yeah, it's a good question, and I know with some people that, let's say, come from their families in real estate, they get very, very involved and learn all the nuances. That really, I didn't feel like that was the case for me. I just knew that my parents had, a house, condo, just some small rentals, and they would go collect rent sometimes, and sometimes the tenants would have problems, and I'd hear about it, but I was completely never involved in any of this, and it wasn't a lot. It was just a few properties that they had. Actually, one property that they eventually got into, when I was in high school, I had no idea about really real estate or commercial, was a bigger property apartment actually in Texas, and they the way they got into that is because these you might see this, or other people from California or other places, brokers will come to California and say, hey, look, it's great to buy in Texas, and give you the whole dog and pony show. And so they basically fell for that, I guess. And then they went out there, bought an apartment. Turned out to be really, really bad because first time landlords, they didn't get educated. Like you probably got your education and learned from some good people. And my parents did none of that. And so they just bought it too big, first time landlords, commercial, out of state, wrong management. And also the timing was, I think, '06 or '07.
Oh,
And everybody knows what happens in '08. So all the things that went wrong pretty much went wrong. So they kind of got burned by that. But luckily things have gotten much better, and they've learned the hard way. So, but yeah, I didn't really have a lot of exposure just growing up. It was just very on the periphery until I actually got involved through my career. But what I was doing in my career was very different from what they were doing, because these were 100, 200, 500 unit properties, and 30, 50, $100 million deals that we were looking at, and it was very different. So it was almost, to me, it felt like there was almost no overlap, even though I knew, okay, everybody's doing some real estate here, but it's still very different.
okay. No, I'm glad you mentioned that because, like sometimes, especially in the Asian American community, your parents don't really teach you. They just kind of do, and you're just kind of there.
Yeah.
So I think because of that kind of upbringing, it made me the reverse, where I like to teach. It's a little more natural, organic for me. But same thing with me. My parents owned like one rental home that was their old home that they lived in and grew up in, right? And then what they did was they upgraded the house to a bigger house. They just kept the prior house as a rental if they can afford it. So that was my only exposure. But just like you, I just remember they would just take me there, and I remember I'd just stay outside and play outside, and my dad would go in there and maybe fix something or collect rent. But I didn't really know what was going on. To me, it was just like, hey, it's fun. I'm somewhere outside. So really glad you mentioned that. And so yeah, let's kind of dive into what you do today. So this is completely different to me, right? um, I guess what you learned in school, did you feel like it translated well to, I guess, to your actual job, or did you kind of learn a lot on the job? Like how that transition go from like, whatever it was, USC or MBA onto your actual first job? Like how was that transition?
Yeah, definitely. So I think with there's a couple of transition periods, I would say, right? And I've mentioned this on some other podcasts before, but I think the transition from being a student to working, right? That was a big transition. I think what USC gave me in school gives you some tools, right? How do you read and write? How do you be analytical? How do you learn? And at least knowing some of the basics, right? The job that I went to actually required that you take a certain classes before you could be eligible for this job, which was a finance class and a real estate class. And I took both of those classes, and at least I knew something about, okay, the finance class was valuation. Okay, what is this thing worth, right? So as you know, and everybody in real estate knows, it's good to figure out what is the property worth, right? And then you'll put in an offer and say, all right, this is what I'm going to get. What if I put this in, and what are the rents, and etc. So that was helpful. And then I took a real estate finance class, which again gave some basics about, okay, how do you do calculations? It was a lot of it was, I think, theory, right? So school teaches you a lot of theory, but when you go out to the real world, it's different. It's not like you can just read a book and say, oh, this is how it works. It's not like taking a test exactly. So I would say I had some fundamentals, some foundation, but a lot of it was learning on the job. So, and I was lucky to have some really good colleagues and some managers and mentors that just really showed me the ropes. So I work for this company called PwC, PricewaterhouseCoopers, which is one of they call it Big Four accounting companies. And in that company and many others, they have a good system of people training other people. So, young people in their 20s that are either new out of grad, or they'll hire MBAs too, and the mid to late 20s or early 30s, and just really good at training people to be productive and within, let's call it, 3 to 6 months. So but it was a lot of work, so long hours and just a lot of studying and learning and asking a lot of questions, and but that learning curve was quite fast, which I think was good in a profession like consulting, finance, things like that. So you work hard and you learn pretty fast. So that was that first transition, and then eventually, I transitioned from working in real estate into being an investor, which is a different one, and I can share more about that later.
Yeah, let's actually just dive into it right now. Perfect segue. So how did that transition work, and I guess how has your kind of mindset shifted from working that job, transitioning over to an investor as well?
Yeah. So that was another transition point, and how I got there. And I think a lot of people talk about like the why, right? Like I'm sure you have a why of real estate, and everybody doing real estate has some kind of why, right? Me too. So when I was working at PwC doing consulting, it was a lot of hours, and then I knew, okay, within a couple of years, I thought, all right, what's my next step? I can get into management. I can go down that pathway, stay in consulting, or what's popular is people go into the industry and then they'll work for a real estate company. At the same time, I was thinking, well, I am in real estate, and is this the career for me forever, right? Or maybe I can. There's so many options in real estate. It's pretty cool, but at the same time, kind of overwhelming. So I just try to spend a lot of time thinking, okay, what do I actually want out of here? But I think one thing that came up was that I think I was feeling so burned out by work that I thought, okay, well, I like this career path. I think it's good, but what about, future planning? And is there a way for me to get into real estate for myself, and then create my own side income, passive income, and then just build for my future? And so that's when I found out about Bigger Pockets, which I'm sure millions of people out there know about. And then I started listening to this podcast, which was actually quite different from what I was doing at work, because I think the gap was, okay, there's these really big properties and portfolios that I work on at work, and then there's the single family, and then the smaller multifamily, and there's this big gap. And I said, well, is there, like, how do I go from one to the other? So I thought, okay, well, I'd like to get into this for myself. And so I really started just absorbing all the podcasts, reading articles, all that stuff, and trying to learn how I can do that. And eventually, so I switched jobs to Marks and Millichap, as you probably know, is a big broker, one of the big brokers in multifamily, and they do all kinds of properties. I really got deep into the numbers there. So in consulting, it was high level, it was strategic, but I really just got into the nitty gritty of like, okay, what's rent? What's pro forma? What are expenses? Just all the line items, and working on these, 4 units to 500. And so I said, okay, I know enough to be dangerous. Like, let me just look at some properties for myself and see what we can get. And so, from that process, that was another segment of the process, but researched markets, and eventually I partnered up with some people, and then we bought a multifamily property, and from there that kind of kicked off that journey of investing.
Great. No, I'm glad you shared your story because, a lot of people, like myself included, I think 5 years out of graduation pharmacy school, that's when people start to kind of burn out, right? The first 5 years, at least for me, I was like, you're very excited. It's very new. You're learning, right? After you kind of hit a point where like you kind of feel like you're on autopilot. I mean, pharmacy doesn't really change that much, to be honest. And I'm sure like, real estate for the most part doesn't really change that rapidly at a high level, at least. Um, so, but yeah, I experienced that as well. And as you mentioned, you had people above you and mentors, and you could see exactly what you would be in like 10, 20, 30 years if you kind of continued on your current path, right? Like I clearly saw that too, where there's some pharmacists, they've been there for 30 years. And I'm like, geez, I cannot see myself being here for 30 years, right? Don't get me wrong, it's a great job and all that, but it just was a little bit, I guess, morbid for me to see that. And I feel like I would regret if I didn't try. So that's what kind of made me go into real estate, just like what you did. Start consuming a lot of content. And it's kind of crazy how, like, even yourself, where, you got an undergraduate, maybe a master's degree in real estate, but despite that, you were still continuing to self-educate yourself with like podcasts, books, YouTube, and just learning from other people. So that's kind of one key thing I want to hit is, it always requires self-education in a way, even if you have formal training in real estate or you don't. There's always some type of self-education from other people. So let's kind of dive into your first deal. Like can you bring us through those numbers on that deal and how you made it work and what time you kind of bought it?
Yeah, for sure. And I just want to emphasize that point that you made, which is a great one, which is that everybody's always learning, right? So for me, I thought, okay, I've been doing this for a couple of years. I've worked with some big companies, but I didn't quite piece together like how do I do this for myself, because the property sizes are different, the markets are different, and so there's still this gap. So it was still a lot of learning. And I think for people out there who are like, there's so much knowledge and information and it seems so far away, it's actually a lot more accessible than you think. I think with things that what you're doing with putting information out there and bigger pockets and so many books, so many groups out there that can teach you. I think it's accessible. So I just want to put that point out there to everybody, and definitely plenty of people who don't come from a real estate background. A lot of people from healthcare or tech or business or marketing or pretty much anything. Teachers, like everybody can get into real estate. It just it just starts with education. That's the first thing. But yeah, so the first deal, and I'll explain what market that we're in right now. So we are pretty invested in the Midwest. Right now, our focus areas are Ohio, like Ohio, Kentucky, specifically the Cincinnati and the Columbus markets, and then Northern Kentucky. And how did we get into that market, right? Person from California, what's that? What's the link here? So I didn't have any friends, didn't have any family out there, just no connection. Just and how we got in there was basically through research. So through consulting, I had a pretty big research-driven background. I used to put together these market research reports, and so I said, okay, I know how to read reports and stuff like that. So in theory. So we researched probably about 10 or 15 markets across the country. And really, we tried to buy in California, Southern California, right? So if some of your listeners know, in Inland Empire, a little bit more east, or, definitely try to look around Los Angeles area. And you're talking about a cap rate, which is basically like your ROI metric. It was really low, like 4 cap, 5 cap, and these numbers are just not working, right? So we said, okay, what else can we do? What about Arizona? What about Vegas? What about Florida? Researched a bunch of places. And eventually we settled in Ohio. And how did we do that? So really, we were looking for a good ROI. And as I mentioned, my parents had this apartment in Texas, but the market was getting really hot really fast. So we said, well, we can either decide to stay in this market or go somewhere else. In retrospect, probably could have stayed there because that market is just skyrocketed.
Yes.
But like I think most people in the market, time helps you, right? So if you're in Texas, if you're in Vegas, Arizona, it's honestly hard to go wrong wherever you did your investing. But at the time, the Midwest and Ohio made sense for us because we were looking at cap rates of 8, 9, 10, and that was just wow. If we're looking at California and it's like a 4 or 5, this is like 2 times the ROI. This just makes sense. So we found our first property actually through LoopNet. So I started cold calling brokers. I said, look, I'm California, got some real estate experience, blah, blah, blah. Most people just blew me off. They're like, this guy is probably gonna waste time. He doesn't know what he's doing, you know. And this was before, like, you know, everybody is investing everywhere out of state. So this was this was not as common years ago. This is 2015 to give, you know, people some context. So not super long time ago, but the market in the last few years has been like a totally, you know, different thing, as you probably know. So yeah, I started cold calling and looking at a lot of deals, and some of these deals look like too good to be true. Like, oh, you're gonna make 20-30% cash on cash. Like that just sounds like crazy. That's like, I don't know, short-term rental, Airbnb of today, which didn't exist back then. But you know, almost got into trouble on some deals and bought in some bad areas almost. I think we lost some deposit money on one deal that looked really good. I think it was a 10 cap, and flew over there, had it under contract, and then it was literally in the middle of nowhere. There was an abandoned gas station and like barely anybody living there, and the place had like no people. So you know, and there was a guy with a dog and a gun, and it was just, I was like, I'm getting out, let's get out of here. We'll lose some money. So yeah, you know, it wasn't easy, but eventually we got our first property off of LoopNet. It was a 28 unit, and you know, the property, after probably looked at least at like 50 or 100 properties, right? So for your listeners, it's like, you know, you're probably very lucky if you look at, you know, 5 or 10 and you get something great, right? You just look at a lot and get your reps in. So we looked at a lot, found this one that was a little bit outside in the suburbs, but looked like a very clean property. And it was, I think, almost fully rented, good rental history. The expenses looked good. The property looked good. And yeah, we put an offer on it, I think within the second or third day, and then just went out there to look at it. And that was our first one. And so after that, then as they say, the first property is one of your hardest to get done. So after that, that really helped us to get a few more properties from that exact broker actually off market. So he helped us to build our portfolio early on and get our you know, foot in the door, basically, to, you know, build our track record, get some experience. And again, we were learning that none of this was perfect. The numbers, all that stuff, none of it was perfect, but we just had to take some action and learned a lot along the way.
Wow, thanks for sharing that as well. I mean, kind of one point I kind of want to hit on is you mentioned you were looking at LoopNet first, right? Like I've said it multiple times that unfortunately most deals on LoopNet are not good, but the great thing about LoopNet is you get to meet the brokers, right? Like that's a way to kind of meet some of the brokers. And as you mentioned, every beginner, no broker will take you seriously, right? Like when you're first starting off, you know, myself, no broker took me seriously. Yourself, I mean, you have formal education in real estate, and even then they don't take you seriously. And, you know, unfortunately, my kind of joke is, you know, brokers make you more broke. That's true 90% of the time, but there's that 10% brokers who are actually really amazing and they can help you scale your portfolio. But the problem is when you're starting off as a beginner, you're not going to attract that 10% that wants to give you those good deals. So, you know, that's kind of one point I want to hit on. And the second point I wanted to hit on was, yeah, like you said, that you're looking at properties. You know, I assume that you've probably never been to many of those states that you're looking at least starting off. Like for me, I would make an offer, get an offer under contract, then I would go visit the state, right?
Yeah.
So, you know, I was doing the same thing in Oklahoma, right? You know, what I kind of teach is you draw a smiley face on the US map. I invest everywhere underneath the smile. That's like the Sun Belt. That's kind of at least my strategy that I do. So, you know, basically I did the same thing in California, right? Like, you know, ideally you want to invest in your backyard. You know, I grew up in Northern California, currently in Southern California, right? So I know California pretty well, but you know, as a beginner, like at least initially, it's hard to start off in California, as you're mentioning, you know, 4 caps, right? Versus the Midwest, you can double that cap rate. So that's why I looked in Oklahoma. I was just like, wait a second, like I can buy a 26 unit for like $500,000, and in California, it gets you a condo. You know, not even San Francisco, you can't even get a condo for $500,000
or less.
Yeah, yeah, yeah. It'd be like, I think in San Francisco, you get like a spot under the bridge, a parking spot under a bridge for like $500,000, right? So to me, I was like, wait a second, all my single families at home I bought were $1 million, but I'm getting this 26 unit for $500,000. It just kind of blew my mind a little bit. But yes, the fear that you mentioned was, especially in 2015, you're right. Back then, out of state was very foreign concept. Like if you talk to anybody, they're like, no, you invest in your backyard, right? That's kind of the common advice. But I started investing in 2017, and that's when I think I started hearing a little bit more about out of state investing. But a lot of people are not willing to leave that comfort zone just yet, and I get it. It's not, number one, buying rental properties is unrelatable. Number two, buying a small apartment complex is even more unrelatable. Number three, buying small apartment complexes out of state, you are like the most unrelatable person ever, right? So, it's not very, comforting, obviously, but, you took the risk and you did your market research, which is what I love, right? You can kind of do all the research. For me personally, I look at city-data.com. That's what I kind of teach. It kind of tells you about the crime, how the population growth is, the job growth, the crime rate. So you can kind of get at least a high level overview of the market. But what kind of helped me choose my specific market was just having boots on the ground, right? As you mentioned, you didn't have friends or family there. Same with me. I don't have friends and family in Oklahoma. But why did I choose Oklahoma? It's because I had a great property manager there who I knew. That's it, right? So because of that, I could run the deal by them first and be like, hey, like, what do you think of the area? If they said the area wasn't great, I just would move on, right? Or I would underwrite the deal just for practice. As you mentioned, you looked at 1,500 deals, wrote 1,500 offers to get your first property. I'm the same way. I probably wrote at least 100 offers. I didn't even use LoopNet or brokers. I went direct mail. I just went purely off market just because I just thought that the deals I was seeing on LoopNet and by brokers weren't that great. And they weren't bringing me good deals and they weren't taking me seriously. So that's why I just said, you know what, instead of complaining and crying, I'm going to take this in my own hands and go straight to the owner. Right. So, that's kind of how I kind of like approached it. And it's kind of interesting to see how it's a very similar path, right? Like success leaves clues. So, my story kind of linked with your story a little bit. And, I started with a small multifamily as well, 26 unit, 28. So let's just kind of dive in a little deeper into that 28 unit. Like what was, what was your offer price? What did you get under contract for? Kind of what were your projections and how did it actually turn out? Like, I'm curious to learn about that.
Yeah, definitely. So the first one was, it's I think there's always, I don't know how it was for you, but there's some fear, right? This is first time for me out of state, first time in this market. And we just didn't know that much, right? And so I had some familiarity with the market at that point. I'd been looking at probably 50 plus deals, all some in the similar places, but all in different places as well. So it was just this learning process. And I think what the broker was asking for was something like $1 million. You're asking for like $1 million in price. And then, I ran our numbers, and then I said, actually, at $1 million, it's not bad. I don't really have complaints about it, but I just try to put in a lower offer, and so I think we started around like 700 something, 700, 725. Just put in like a really low offer. But what we were trying to do is just say that we can, offer fast, and we know what we're doing, and offer some reasonable terms, and we can work with banks, right? So. Eventually negotiated back and forth. We got it for, I think the price was 838, which was a pretty, bit of a not, odd number. It's not like 850, it's not 825, but anyway, that was the number that eventually we buyer and seller agreed to, and broker made that happen. So we got that deal under contract. And then as far as how we did our initial underwriting, so we looked at the current rents, and I know now, and you probably see the same thing. If you look at a broker's deal, they'll tell you, okay, these are the rents now, but really they'll focus on what the upside rents are, right? And they'll say pro forma is, $1,000 a unit, even though now it's like $700. So we were not even looking at pro forma. We were looking at just in place today. worst case scenario, we're not going to get $1 more rent, and we want our numbers to look good just today, no changes. So, underwriting has changed and evolved a little bit since then, but that's where we thought we would be conservative. So we used the in-place rents, and honestly, didn't even really know what market rents were at that point because, I thought, well, there's probably some upside, I think, because some rents are higher, some rents are lower, and we can probably push them to the highest rent. But, at that point, we didn't even really do like a total rent study, all that stuff. But we're just trying to get an offer out there. So that's how we did that. And then expense ratio, looked at all the current in place. Basically, everything was in place. And then we added management fee, all that stuff. And, I won't go through every single line item, but we try to be pretty much as conservative as possible. And add a cushion. And I think our expense ratio is probably around 50-ish%. Just slap a 50 on there. And in general, that should be okay, right? Plus or minus 19, 70-ish property. Looked like it was being well maintained. So put some vacancy on it. So that's when we went in, and I think our numbers were, it was like a double-digit cash on cash, and probably like 8.5, 9 cap rate. So debt at that time was I think like 5%, 6%. So pretty reasonable numbers. And then that's how we did our 60-day contract, 30-day diligence, reviewing all the financial information, physically looked at the property. We found an inspection company to look at it. They came back with a couple of things, and I think the owner was willing to fix those things, relatively minor. And then we did that loan with National Bank, Wells Fargo, who lends in Ohio. And I think we put like a 15-year loan on that. So that was, just based on, I guess, sort of the conservative thinking. Me and partners thought, okay, maybe we'll just hold this for the long run and see if we can pay it off, and then really try to get that passive income by eliminating the debt at some point. So that was the particular strategy with that one.
Okay. Wow. No, people need to rewind and listen to that section again because really appreciate that detail there. So I guess on that deal, I love how you mentioned that, yes, you look at actual income, right? The brokers, I always joke that the pro forma that they give you offering memorandum was like 30 pages. You're trying to cover something up, right? So you kind of have to weave through it. That's why I'm a little bit harder on brokers. I apologize in advance. But basically you have to use actual numbers, right? And then for the pro forma rents, take it with a grain of salt, right? The best way to validate it is talk to your property manager that you have, right? If you already have properties in that market, you'll know what the market rents are, right? Like in Oklahoma, I know for a C-class 1970s value-add apartment complex, the starting rent's probably around 400, 500. But if I'm able to renovate it, about 8 to 10K per unit, make it more modern, you're talking about maybe 700 for a 1-bedroom, maybe 800 for a 2-bedroom, right? Like I know that just through talking to my property manager, you can obviously check like Section 8 fair market rents. It's public information. That's another source of reference. And then you can also just Google, apartments.com, look at apartment complexes in that area, right? So that's how you kind of do a quick study, but your best bet is a property manager, right? The one that you're going to use, because they're going to be the ones to know, like, you have to do X amount of renovations to get this rent, or you can do absolutely nothing, just do basic, touch-ups, make readies, take care of routine maintenance, and you can bump up the rents. So, love how you mentioned that. And then the expense ratio of 50%, right? That's actually the rule I use as well. Oklahoma, it's about 55%. Insurance is going up a bit, this year, unfortunately, in most markets. But 50% is a quick, easy rule of thumb, right? So your actual annual rents is 10K, expense 50%, right? So your NOI is 50K, and then you do your cap rate. That's how you find your value, right? That's a quick and easy way to evaluate it. And so that's the trap that people fall into, right? Like, just don't blindly trust what the broker gives you. You have to do your own due diligence, right? Of course, they're gonna make the rents higher, because if the rents look higher, it justifies a higher ARV at the end, and hopefully to get you to pay more. And something that you said that I love that you did was you just wrote offers. Like, you wrote offers that made sense to you. And a lot of people do not do that, right? I'm in the process of selling my mobile park right now. People say they're going to write an offer. They never write an offer. They just say they're going to do it. But for me, if I say I'm going to make an offer and what you did too, I actually made an offer. And just the fact that you made an offer fast shows that, hey, I'm willing to play ball, right? You may not like my offer, but hey, let's talk. Let's continue talking. And maybe we can come to a price in the middle that works for both of us, which is exactly what you did, right? They listed for $1 million. You offered 700. You kind of met in the middle a little bit, right? At 838. So, just the fact that you're making offers, and I did that same thing. Like, I just wrote offers that made sense for me. If, there's a huge bidding war, so I was buying multifamily in 2021, which was hot. Interest rates were low. So I just said, you know what, this doesn't make sense for me anymore. I'm out, right? So, really love that you mentioned that. So kind of one thing I want to hit on is you mentioned that you basically underwrote double-digit cash-on-cash return day one, right? Like when you actually took over that property, did that actually come to fruition, or was it different? Can you kind of describe that process when you kind of first took over that property? Did kind of reality meet expectations?
Yeah, no, it's a good point. And for what I remember, we did not quite get there. And so I think there's a couple of things that happen, right? Is your projections, and an ideal world, like your projections are like, hey, I'm going to get 10% cash on cash, and then you get it, right? I don't know if you did that on your first deal, but for us, did not happen. So, there's tenants that move out. There's maybe somebody stops paying. There's some unexpected maintenance thing costs more. Pretty much what you can expect in real estate, I think, is things are going to cost more and your rents might not be as high. So to be conservative. Now, if you're, really, really on the dot, perfect, everything lined up very well, then I think you can hit those numbers. And that's a process over time that we've learned. So, really trying to get more accurate on our numbers. Is it ever going to be 100%? I don't think it is, but we try to get as close as possible. So I would say we were slightly under double digit, maybe like, 7, 8, 9, something like that. Starting off, which was not bad, right? This is better than we can get in California. And then the price was just, it was bang for the buck, right? You're talking under $1 million and you get almost 30 doors. And that's like, like you said, that's maybe a house in somewhere in Southern California or the Bay Area. So we're like, well, we're making money here, and it's takes a lot of work, right? So I think sometimes the myth of passive income, I think it's actually a myth. There's no such thing, unless you're a true LP. Then actually that is passive. So that's another thing that we're doing. I can talk about that later, but yeah, it was a learning process. So it took us probably 6 to 12 months to stabilize that. We got good management there. We leased it up. We turned some units, got some bad tenants out, and then it started performing. And it's actually, performing quite well. I think it's performing at double digit right now. And then some of the strategies, I think you do this and other people is you can refinance later, right? So, two things help with that. One is buying below market. So I think your strategy of the direct mail makes a lot of sense, right? Because once it touches the broker's hand, it's like, the price it just goes into a different territory. It hits this like this curve that's like an exponential curve. Like, oh, it was priced at this, seller is okay with this, and the broker's like, well, you can actually get this. So yeah, I think it's all about what you can buy it for, and then how you operate it. Management, like you're talking about, super important. I wouldn't go into any market anywhere without a good manager that you can trust, is reliable, knows the market, and good communication, all that stuff. So those are all critical things to making something work. And it was a learning process, right? Like we didn't, we turned over management, a couple times until we got the right one. And, that's the biggest thing. I think investing outside of your area is just, you really got to get the right management on board, because that's the make or break. They can turn a good property into a bad one, or vice versa. You bought an okay property or not so good one, and they can make it successful for you. So that's really important.
Oh, I'm glad you said that. That's funny. I say that exact phrase as well. I must have been your classmate at USC without even knowing it. But yes, you have a good property manager and a bad deal, they can make it into a good deal. If you have a good deal with a bad property manager, it's a bad deal. Right. So really glad that you echoed that. And one thing I want to mention, and I love your transparency, because I'm the same way. I said, hey, I underwrote my first 26 unit. It was 12% cash on cash return. The moment I took over, I had 2 tenants stop paying me and they left. I had 3 more tenants move out. So you just lost 5 tenants. That 10 cash return is gone, right? So, and then on top of that, you have the tenants that are there. They're like, hey, this thing is broken over here. Can you fix this? Can you fix this here and there? And then there you go, right? So maybe now you went from 10% cash on cash to maybe break even, or maybe putting a little money in it. But when you start off in, C-class apartment complexes, where me and you both started off, right? Like, 1970s, about 20, upper 20s units. Sometimes, a lot of times, they're self-managed by a landlord who's tired, right? Mom and pop that owns it. And they really haven't raised rents in the past like 5 years because the property's paid off. They owned it for 20, 30 years. So they're not motivated. They just want the minimum amount of effort, because if a tenant leaves, it requires a lot of work to turn the unit and then to lease it out again. And if you're self-managing, you don't want to deal with that, right? I get it. I wouldn't want it either. But for us, we're coming in and we're like, okay, I know I can renovate these units. I know I can raise the rents, and it takes a lot to stabilize. Like, I've been stabilizing my 26 unit. I'm still stabilized. I've owned it for 2 years now, right? Like, for the first 6 months, I couldn't get a contractor, and all the supply chain issues. I couldn't get all the equipment I needed or the supplies I needed. But fast forward 2 years now, I have almost 2 more units that I need left to be finished. And, I basically hit my rents. Like, I'm around 700 to 800 now. But it took 2 years, right? Like, and then at this point, once it's stabilized, that's when your cash flow really starts to skyrocket, as you mentioned, right? And that's when you do your cash out refinance, you pull out your equity, your renovation costs, and then hopefully a little extra on top of that, and you can buy more real estate. So, that's what I kind of did. And what you mentioned too was off market. I bought my 26 unit of $250,000 equity day one. I bought for $500,000, appraised at 750. Right? If this was given to a broker, they probably would have listed at close to $1 million. Right? Like, kind of similar. And then I could, after raising the rents by like $200 to $300 per unit, the ARV that I was kind of estimating at the time was like about 1.3 to 1.5 million. So that's kind of your margin there. So very similar story. So I guess for your deal, how'd you fund the down payment? Like, did you do that yourself? Did you raise money? Did you go into partners? Like, how'd you kind of fund that down payment?
Yeah. So what we did on that first deal, the first one was just trying to figure out what size range we could go after, right? So I think that's a big one for people starting off, is just, okay, what funds do you have now? I think it's good starting point to try to start to buy something on your own or with a few partners. I think it's a good way to learn. Or another way is just invest in somebody else's project and just learn that way as well. But always try to be, I think, conservative, right? So you don't want to stretch yourself so thin and then just expend all your funds. And then, like you said, if people move out or you have maintenance expenses, you're like, oh shoot, I don't have any cash to fix this stuff. And that's where I've seen a lot of people run into issues. So always try to be conservative on that. So for us, we knew, between me and my partners who were like, hey, we're motivated, we're looking for something. Here's our, pool of funds that we can put together. So it was basically between me and a couple other partners that had our funds together. We said, we can buy up to this range. And so we said, at the listing price, we can still toss offers at these outside of our range, but we just need to put in some low offers. So that's what kind of restricted our upper end of the offer price. So we funded that ourselves with a couple partners. And then from there, just, it was, I know some people like raise money or does a lot of creative financing. We didn't know all those different strategies back then, like seller financing, that we've, gotten a lot smarter about now and learned about. So we've been using a lot of those more creative strategies recently. But our first few deals, it was slow. It was a grind. It's in working the W-2 and doing this on the side, as as and it's hard to multitask. And then it's it just took time for us to kind of slowly build. So we rely on our own funds. We didn't really have a bunch of partners. We didn't really raise money. And a lot of people have moved super fast that way. So for us, it was kind of just slow and steady. Okay, we did this one deal. Now we've got a little bit more funds from our W-2 jobs or some cash flow, and then put it towards the next one. But another strategy too that one of my partners used is using a line of credit. So we used the line of credit to fund some of our other deals after that. And then for there, again, I just emphasize like to be conservative, right? Because you don't want to get too over leveraged. And so, that was a strategy that worked, but we didn't want to, keep continuing to use that. So that was kind of our funding strategy. And we've, kind of evolved into the other different ways now. And then now we're, raising money and being able to scale a little bit faster that way.
Okay, yeah, let's talk. I know we're kind of running short on time, but let's kind of talk about scale. Like, so what does your portfolio look like today? And how did that progression go? I guess since from your first apartment complex that you purchased.
Yeah. Just so the quick kind of progression rundown. So 2015, we bought a 28 unit, and then 2016, we got a 43 unit. And then 2017, so it's about one per year. 2017 got a 12 unit. And so, kind of steady progress. Between that period of 2017 to probably about 21, 22, there's like this big gap. And why is that gap? One is we ran out of funds. So ran out of funds, got tapped out. That's one. And the second one was that I ended up changing jobs to this private equity firm where I learned a lot, but I really just had to grind a lot. I was pulling 70, 80, 100 hours a week. And it just like, that was my life for like 3 years. And so, and then I went back to grad school, which was another thing. But it was a good experience. I learned a lot. I kind of half regret that I wasn't in the market, because continuing to buy, even if it was like one a year or one or two a year, that would have, changed my life, my trajectory, as you probably know. So and the market conditions and all that stuff is just timing is everything. So but anyway, it is what it is. It happened. Went back to grad school, decided, okay, I want to scale this up more. So 2022 was a pretty active year for us, where I brought on 2 or 3 other people on my team. And so we bought about 5 deals last year. And that was about probably, I'd say, about 70 doors. And then again, this year I decided to, and those were still all joint ventures. So we've done all joint ventures up until basically this year. Decided to scale up again. And so I joined an investment group and met some other partners. And so this year, so far, we have closed 133 doors, and those have been through syndication. So we work with investors, so our partners, limited partners, to raise funds from them and then have them partner with us on our projects. And that's been able to help us to scale up. And what we like about that too is offering opportunities to investors to get double-digit returns, and they don't have to actually do any work. So we try to make it comparable to a person who says, hey, I want to do this on my own, buy a duplex, buy a fourplex. And, what do those numbers look like versus what does it look like to invest passively? And, I've done it myself. I own, a duplex, a fourplex, and those actually don't perform as well as the bigger deals. Because as you know, with a duplex, if you have one vacant, you're 50% vacant. Yes. So we think actually it's quite attractive to be a limited passive partner. You can make the same, if not more. And the nice thing is you don't do any work. It's just like, putting your money in stocks, but we think it's actually less risky than the stock market, especially right now. So that's kind of where we're at now in terms of our progression and looking to scale with our partners and offer more opportunities. Still doing joint ventures and offering syndications to people that want to plan for their retirement, or say, hey, I want to do real estate but just don't have the time, the interest, or don't want to do the work. It's a lot of work, as you know. It can be risky if you are unsure, don't have the right management. I mean, I would say it's actually harder to make something work than it is for it to fail. So we're trying to remove some of the barriers for people there.
Okay, great. Yeah, thanks for talking about your scaling. I feel like I need to bring you back on for the scaling portion. And I know you have a pretty big stars that would love to bring you on to dive a little deeper in terms of your scale. I loved how you mentioned that, you took a 3-year pause, and at the grand scheme of things, that's okay, right? Like different seasons of life. If there's a season of life where your W-2 is too busy, you're not going to be able to scale as rapidly, right? Because you have a certain mental capacity you can do. And, once you hit that mental capacity, you cannot move forward. And that's what happened to me when I hit 90. I'm just like, this is it. I maxed out, right? So, until things stabilize or offset one, that's when I can do it. So would love to bring you back on for the scaling portion. And I apologize. I got too into your story. I didn't talk to you about direct mail. But could we schedule some more time to talk about direct mail, and I can deep dive, do a masterclass for direct mail for you?
Yeah, would love to do that. Yeah, we can definitely schedule another time.
Yeah.
Happy to talk more about the scaling portion, or if you want to deep dive into specific topics, happy to share what was helpful.
Yeah, because definitely, the direct mail has been like number one question that I've been getting asked.
Mhm.
I've had some success with it, and you can bypass the broker, and it's great for beginners, but also great for people trying to raise money, right? Because imagine if you buy a multifamily of instant equity day one and have the ability to raise rents and force appreciation, you cannot lose, right?
Mhm.
Like you basically cannot lose, even if interest rates go up and screw you over, which happened to me, right? That happened to me. Interest rates doubled compared to like a year ago. And despite that, I was still able to execute a cash out refinance, pull out my renovation costs, at least not my down payment, but hey, just hold it for another 3-5 more years. Interest rates drop, do that refinance. Good. You have all your money out, right? It's a long-term game. So, definitely would love to bring you on again and to talk about direct mail, and then also the scaling portion for that.
Okay. Yeah, no,
Yeah.
that definitely sounds good.
Yeah. All right. Cool, man. Thanks for that. Sorry about that. I actually had a hard stop at noon for some lunch with my girlfriend. But when are you